I would like to welcome our presenters today, Brooke Fernandez, General Manager of Main Data Group, and Adam Kahle, Principal at Meyer. Brooke Fernandez joined MDG in 2022 and has deep experience in services, technology, and B2B SaaS subscription services. Over the last decade, her career has focused on sales and marketing roles, building and executing go-to-market strategies for startups and more mature companies. Adam Kahle has more than 20 years of experience in both corporate compensation and consulting. His consulting experience covers a range of industries, including business services, consumer products, education, energy, financial services, healthcare, industrial manufacturing, life sciences, media, telecommunications, retail, transportation, and technology. In 2023, Adam led Meyer's efforts in assisting a wide range of clients with PVP calculations and disclosures. So at this time, without further ado, I would like to welcome Brooke Fernandez. Welcome.
Hi, everybody. Thanks for joining us today. So we've got a special guest here. Adam and I are going to be walking you through a variety of subject matter on the pay versus performance, just overall kind of view of the market and what we should be able to answer in your roles today. So we're going to start out first by just talking about a little bit about the relationship between Main Data Group and Meyer. Meyer is a leading executive compensation firm, and Main Data Group is one of the key partner companies within the Meyer brand portfolio. So we are a proxy database, and a lot of the research that our consultants use at Meyer comes from the Main Data Group platform. So we'll talk about how to use the database in a minute, but to just get started, we're going to go through the agenda here. So first, we're going to start out with what is pay versus performance? What are the new disclosure rules? Then we're going to walk you through some of the trends in terms of what we're seeing with these early filers or just the first filing that we've seen. We've got about 3,000 companies, around 3,100 in fact, that have filed so far that we have PVP data on in the Main Data Group database. So we're going to talk about the trends that we see across that data set in terms of what people are disclosing, how they're disclosing it, and what you need to be thinking about with your particular industry or your particular peer group. We're also going to be talking about what questions you should be prepared for to answer, either from your stakeholders, your investors, your board, or even your management. You might be faced with some new kind of conundrums with how to do these filings and kind of what the relationships mean. Finally, we're going to talk about how you make sense of your own results in the context of your peer group. So we're going to give you a couple of examples of how to think about this overall new disclosure requirement and how it kind of fits into longer term strategies. And then finally, we'll save the Q&A for the end, but please don't hesitate as something comes up as we're talking to put a question in the Q&A pod. We'll be also sending out the presentation at the end, as well as if you'd like for us to communicate with you on this topic, please make sure that you're opted into the World at Work communications. So you go into the World at Work profile and make sure that you're opted in for communications so you can receive the slide deck as well as any other further white papers or any other commentary on this subject that we put out. Okay, with that, let's get going. First, we'd like to start out with a poll, and I will have Mike put that up for us. So the first kind of icebreaker poll we wanted to do is, who did you engage to help you with your PVP disclosures and calculations, as well as the analysis? You might have had a couple of different people you worked with, either law firm, consulting firm, variety of the other stakeholders as far as equity valuation firms. So it could be a couple of different folks that you inquired with or consulted with, or maybe you did it on your own. Love to hear from that group. Got about, let's see, gonna give it a couple more seconds here. About halfway through. Don't be shy. Okay, a little bit, couple more seconds. Okay, I'm going to end it now. Okay. Can everyone see the results?
Yes.
Can you see those, Adam? Great. So interesting. We've got a bulk of people going to internal company and resources and using your own internal teams. Got second in command here as the comp consulting firms. very few people used, law firms or valuation firms from the data set have responded, but also we've got the most common answer is you're not sure.
Well,
Go ahead, Adam. Yeah.
that makes me happy that we're talking about the details of the rule next. We didn't want to bore you with that, but it sounds like there's a number of people who haven't been involved with this yet. So that's good to hear. We'll certainly get into the details of the rule.
Right. Yeah. So we'll take everyone from the top. So what is this new rule? So just to kind of give you a very kind of high level overview here, this rule took about a decade in the making. So it came out of the Dodd-Frank Act, and in August of last year, we finally had the final rule from the SEC. And it was sort of a quick change, in fact, in terms of people were kind of caught off guard with the quickness of how they had to implement this. So for example, the rule was put in place in August, and it was for the 2023 proxy season. So some people only had a couple of months, less than 6 months to prepare. So depending on when your filing date was, if you were early in the year, you had a very limited time to kind of get your arms around what these new rules entailed. So there's two primary components: the compensation disclosure and the performance disclosure. You must now include a new table, and we're going to show you that on the next slide, with 5 years of data. Initially a 3-year. So for example, the first proxies we're seeing now in the 2023 filing season are 3 years of data, and then you're going to phase into 2 additional years. You're adding 1 at a time and as we go forward. And we're going to be talking a lot about this compensation actually paid. So we're going to hear a lot about that, and we're going to hear a lot about total shareholder return. So those are 2 main components. So we've got a summary compensation table, total compensation for the CEO, and average of the other NEOs as part of the compensation disclosure. Number 2 is you actually have to put the compensation actually paid to the CEO and average of other NEOs. And we're going to talk about what makes up that compensation actually paid number and how it reflects and has a relationship with the SCT. The second piece is the performance disclosure, total shareholder return for the company and its peer group, company net income, and the most important financial metric used to determine the compensation actually paid in the most recent fiscal year. Now, you also have a final thing where you have the tabular disclosure, including 3 to 7 most important measures driving the NEO compensation. So we're going to talk about the 2. We're going to show you a table on the next slide. One other important note is to remember, if you are a smaller reporting company, you only need to supply 2 years of data. So, and only company TSR and net income. So there's a different requirement for you if you are an SRC than a larger company. So let's get into this. Let's show the table on the next slide. And Adam, I will have you kind of walk the folks through a little bit of what you see here, and follow up with anything that I missed on the last slide.
No, I think you did a good job, Brooke. Thanks. And, one other thing to think about with this rulemaking is when the SEC implements a new rule, they first go through a comment period where they get feedback from, experts in the field. And a lot of law firms and compensation consultants opined on what they thought is important to have in this. As a result, this concept of compensation actually paid has become fairly complex. And I think that's as a result of getting feedback from multiple parties. And, some people wanted to see realizable pay. Some people wanted to see realized. And as a result of all that feedback, the SEC took all those comments into account, and they put together a real fulsome measure. But what we'll talk about in terms of compensation actually paid is this compensation actually paid is a bit of a misnomer because it represents a variety of things. And the last thing I'll say is just to demonstrate how complex these rules got, the final page count on the ruling was 233 pages. So it took a significant amount of time. It caught a lot of people by surprise in August, and it took a lot of time from the experts and from companies to dig through the rules and really interpret it and figure out how to make it make sense for their company. If you can go back one slide, Brooke, I'll just talk about this table real quick. So again, this is the table for the first year. If you're a full reporting company, you do 3 years of data. And what you see is you report your summary compensation table total for the CEO and average of the other NEOs. You report the compensation actually paid in here. Your TSR is based on an index TSR, just like in a performance graph in a 10K, it'll start at $100 and then go in year one and then go from there. Same with the peer group. We'll talk about what peer group you select. You have some options there, but ultimately you have to do the same for a peer group. Then you report your net income and this company selected measure, which it's really up to you as a company to determine what's the most important financial measure that aligns with executive pay in each year. So I think that's the highlight of it. One other thing I'll note is, and maybe a lot of you who answered don't know or unsure, is that for emerging growth companies were lucky enough to be exempt from the rules. But to the extent you ever, your company gets out of emerging growth status, you'll be responsible for creating this. So I expect maybe a number of you are from, EGCs. So that's the table. On the next slide, we'll get into some details on this. As I said, this very complex thing known as CAP. So when we initially got the rules stated, that there should be a number of adjustments from summary compensation table to CAP related to pension, deferred comp, and equity. But in terms of when the initial rules were released, there wasn't a requirement to really get into the details of this in the proxy statement. Just subsequent to the rules, the SEC released some initial guidance and actually said that you need to provide in the proxy statement another supplemental table that shows in detail each of the adjustments that you made to get from summary compensation table compensation to CAP. And so we'll walk through these briefly. So first of all is pension. So you start by getting the total from your summary comp table, and then you add or subtract these various items. So from pension, you delete, or rather you subtract the value of the pension benefits that are disclosed in the summary comp table, and that's based on the actuarial present value. But you add in the service cost, and service cost really relates to like cost in each of the years. So you add in that amount, and that's amount that you would have to get from your actuary ultimately. In terms of deferred compensation, if you have any deferred compensation above market earnings that are not tax qualified, that's something that needs to be added in. Now, equity compensation, I think is what took most of the time for people to prepare to do all these various adjustments. So you start out by subtracting the grant date fair value from the summary compensation table, and then you add in or subtract the following amounts. So first of all is change in vested value. So to the extent that any award vests within the given fiscal year, you have to measure the fair value on the vest date subtracted by the fair value as of the prior fiscal year end. For anything that is still outstanding or unvested by the end of each fiscal year, you take the fair value of the awards as of the end of the fiscal year and subtract it by the fair value as of the prior fiscal year. Forfeitures, to the extent that a named executive officer was terminated and had a forfeit award, for example, you've got to take the fair value as of the prior fiscal year end and subtract that. And lastly is dividends. To the extent that you didn't account for dividends in your grant date fair value, you've got to include that. You've got to make a separate addition for that. So you see, this is a lot of information in CAP, and it's interesting to note that this concept is called compensation actually paid. But as I said, that's a bit of a misnomer because this doesn't represent what an executive is getting paid in each year. It's not W-2 income, for example. The vested value is certainly the paid piece, but the change in value of outstanding, that's more realizable. So that's something that can be realized in the future if the executive continues to be there, but it's still subject to performance in terms of the stock price, in terms of the performance on the performance shares metrics, for example. So let's move on to the next slide. We wanted to show you actually what this table looks like in proxies. There's different ways that companies have put it together. And I know this is a bit of an eye chart, but when we send this out to you, there will be links as well to the proxy statements. But for example, I think the top one, the vertical one, is what we've probably saw most companies do. And then it's just listing, like you saw in the previous table, the adjustments on the left-hand side, and then columns for the years and the CEO versus the average of the other NEOs. I think this is a table that encapsulates everything into one, which is nice. The next one on the bottom is an example from 3M, and this is just kind of a more horizontal approach where we have rows for the years and columns for the adjustments that are made. And this one just shows it for the CEO. So 3M actually did two separate tables, one for the CEO, one for the average of other NEOs. I think the only disadvantage of this approach is those words get kind of hard to read in the columns, and then you got to do kind of two separate tables. So yeah. Just wanted to show you what it looks like in terms of what we've seen.
Yeah, stylistic choices that people are making out there. Yeah.
So in addition to all that stuff, you've got to really footnote the details, footnote any assumptions that you make. So, a lot of companies have changing CEOs over this 3-year time period. So that principal executive officer, that refers to the CEO. You've got to footnote who the CEO was in each year, the effective date of when they were a CEO, et cetera. As you saw in CAP, you've got to do kind of revaluation of equity based on fair values at vesting dates or fiscal year ends. To the extent you use any materially different valuation assumptions than you use at the grant date, you've got to footnote what those are. Most companies didn't do that. Most companies just kind of stuck with their same valuation assumptions. Peer group composition, to the extent that you don't use a published index, like the S&P 500 materials index or something that is published online, to the extent you're using a compensation peer group, a performance peer group, so on, you've got to list who those companies are. If your peer group changes, you've got to note that. The detailed reconciliations from SCT to CAP, we noted that that's provided in the table. And then if you're using a non-GAAP measure as your company selected measure, that's the measure that you deem has the greatest correlation with executive pay in each year. You just got to disclose the reconciliations from the non-GAAP to GAAP measure. Most companies just did that by referencing a section in the proxy statement, but that's the majority of it. Okay. So easier said than done, right? When it comes down to it, not only was it difficult to interpret these rules, but as we worked with clients to really dig into this, we realized there's some really big complexities in this in some cases, especially in companies that have complex equity instruments or in have complex performance-based awards or in special situations. So we'll just kind of touch on some of the biggest ones that we saw here. The first of all, the big point of this is just capturing all the data that was required to make these calculations. It took a lot of time just to work with clients to describe exactly what was needed and to make sure that we got all the information required. So what it means is you've got to really get equity data on anyone who is an NEO over the past 3 years. And for those NEOs, you really need equity grant history that represents anything that was still unvested during the time period, which means if you think about companies that have long or 3-year vesting schedules, you've really got to go back not 3 years, but sometimes 4 or 5 or 6 years in terms of grant data to get equity grant history for the company. And not only do you need to know the grant date information, but you need to make sure you have complete information on the vesting schedules, performance metrics used, the probable outcome for performance on those PSUs in each year. And then lastly, I think stock options created some of the most complexity in this, and that we mentioned you need to do a fair value of vested and unvested in each year. And it's not as simple as the intrinsic value of taking the stock price at vest or at the fiscal year end and looking at what the difference is over the exercise price. the rules actually require you to revalue the options using the Black-Scholes model, or using the same model that you use to grant the instrument, to look at what the outstanding value of that option is. So that required a lot of complex calculations. And not only do you have to do it for each grant, you have to do it for each tranche. So if you're in a biotech that has 36 monthly vesting periods, you've got to, for every single grant, value 36 tranches, and so on. So these spreadsheets have become very complex. Some clients we've worked with have 400 plus rows of just the equity valuation data to get at this information.
Wow.
So that's kind of the high points on the equity valuation piece. On performance-based equity, one thing to note is a lot of companies now have performance shares that have a market-based metric like TSR or stock price. You are required per the rules to actually revalue those awards as of each fiscal year end, using the Monte Carlo valuation, because the Monte Carlo valuation is what is used for those types of awards at grant. So it actually requires you reaching out to your evaluation firm and having them, for every outstanding award, value the Monte Carlo for each of those. I mentioned biotechs before. Biotechs, for example, have a lot of milestone-based goals, not necessarily financial, but that require achievement of reaching certain drug milestones, and those can just be difficult to track in each year, and it's just something that causes additional complexity. Lastly, I think when the SEC was putting this together, they were thinking about kind of the standard company, but think about companies that went through an IPO over this period, or had a transaction like a merger or a spinoff, that required additional complexity in putting this together. For an IPO, for example, there's some question as to whether you start your initial valuation on the IPO date or on the beginning of that calendar year in which it occurred. Most companies landed on using the actual IPO date as the beginning of the valuation period. So there was some confusion on that initially, but it seems most companies have moved to that approach. Multiple CEOs, if you've got CEOs that change in each time period, you've got to capture that. And you've even have some instances in which those CEOs were former NEOs and show up, in former years. So it just, adds additional complexity in just making sure you've got all the right data for each of the years. And the last thing I'll note is, over this period, it was a 3-year period of some volatile stock price movements, especially from 2021 to 2022. Kind of stock price went down from kind of went up from 2020 to 2021, and then down from 21 to 2022. So you'll see in the results for a lot of companies is not only did stock price move over that period, but that cap moved pretty drastically over that time period, and most of that was simply due to the changes in stock price, especially for companies that had stock options where the valuations really changed.
Okay, great. All right, got another poll coming up. We'd like to know, based on your experience, if you did do a disclosure this year, how many hours did you estimate that this took you and or your team? We think that there might have been a radical underestimation by the SEC in terms of time estimate on this one. So let's see what we've got here. I'm going to give it a couple more seconds.
Yeah, we initially had the last responses, don't know, unsure, but I like that, Brooke, you changed it to don't know, don't want to know.
Right, because it was probably painful.
Yeah.
At the time, so I don't want to reflect too deeply on it. All right, let's end this. Here we go. Okay, we have got the big winner, and it's just don't want to know for sure. But let's see. So Adam, let's take it from the top for the folks here. So you mentioned that the SEC had an estimate of what they anticipated
So
thing
these
about-
results, yeah, these results came out like expected, that most people who knew said it was over 40 hours.
Yeah.
And absolutely, I think that's what we saw with most of this. I think in this first year, it took a lot just to figure things out. I think now that companies have, their calculations, their templates in place, it'll be easier next year. But I think the SEC drastically underestimated the timing required. So, when the SEC releases a new rule, one of the things they need to do is estimate the average burden it's going to take for companies to comply with it. And what they said was for, full reporting companies, not SRCs, it would take 15 to 28 hours, and for SRCs, only 15 to 17 hours. So I'm glad to hear that some of you said, less than 20 hours, but that was only like 4% of the responses here. But yeah, it seems like the majority of people took over 40 hours, which I'm not surprised.
Yeah, and to your point, it's one of those things where you have to invest up front to just design this period. And then once the templates are in place, it's going to hopefully be much less of a lift next year.
Absolutely.
Hopefully. We'll see. Okay, let's do some best practices. What are the trends we're seeing, Adam? Now that we know what this is all about, let's
Yeah,
talk
so
through what we're seeing.
yeah, so Brooke mentioned up front that we've got, in our database about 3,000, companies and their PVP practices. We did a look at the database as of end of May. So as of June 20th here, we've got many more companies, but we just froze the database as of end of May, and we're showing you here kind of the main trends that we saw. So first of all, as you looked at the types of companies in the database, just keep in mind that the majority, 79%, were the full reporting companies that we mentioned. About 20% were SRCs. As you look at the company selected measure that was used, the vast majority used a non-GAAP measure, which doesn't surprise us, because when you think about what companies used as the CSM, most of them used the most heavily weighted measure that was in their annual incentive plan. And most companies in their annual incentive plan are using a non-GAAP measure that, has some adjustments in it for items that are kind of outside of management's control. So not surprised to see that. The bottom left chart is interesting, is that you are only required to report one company selected measure in the table, but there were a few companies that decided to report two for some reason. So that's interesting.
Yeah.
And then lastly, that list of other measures that, this is the tabular list that Brooke was mentioning that you do in addition to the CSM. Of those, the majority of them were financial measures, about 90% were financial, but about 9% did provide a list of some other non-financial measures. On the next slide, we've got some data on like the actual magnitude of for that sample of about 2,400 companies, what the reported summary comp table number was, the cap number, and we've got it here for both CEOs and NEOs, and this represents the most recent 2020 year. So we've just shown it for that last year of data. What's interesting on this is that as you look at the median and 75th percentile, and you're looking at the biggest dark green bar there is for the summary comp table total for the CEO. That the cap was less at the median, the compensation actually paid was less at the median and the 75th percentile. That's interesting. And I think the biggest driver of that is the fact that for most companies from, fiscal year end 21 to 22, stock prices declined. And like we said, the biggest driver of that cap is stock price. So we're not surprised to see that for the CEO, the cap was less than summary comp table comp. Looking at the 90th percentile, though, you'll notice that cap, the bright orange at 16.1 million was higher than the summary comp table in full at 15.9. I think that's just driven by kind of 90th percentile performance companies did have cap that was higher than the summary comp table information. And conversely, it's interesting when you look at the 10th percentile, you see that huge negative cap number. And this really surprised people when they started to really realize the outcome of cap, is that in fact, you will see a number of companies that have a negative compensation actually paid. And this really confused a lot of our board members, comp committee members who are saying, this doesn't make sense. You're calling it compensation actually paid, but it's a negative number. Were they required to pay something back to the company? So that just goes to show you compensation actually paid isn't compensation actually paid. That negative number that you're seeing is either for companies that had forfeitures where an executive had to terminate and had to, give away or had to, cancel some of their equity, or companies that had, significantly declining stock price over the period.
Mhm. Yeah.
So again, I mean, the end results here is that every company is different. We saw wide ranges in this and, continue to be a highly volatile result in each year, really based on stock price.
Yeah. And again, back to the time binding of this, it's every single year is viewed independently, right? So that's kind of also what's driving some of these really strange outcomes on the cap side.
Yeah.
All right.
So what did these disclosures look like? Some of them were very lengthy, but some companies decided to just do the bare minimum in terms of complying with this and just to view it as a compliance exercise. So the average word count of the sample was about 1,400 words. But there's quite a big range there. You'll see one company just used 30 words, was very to the point. In terms of the number of charts that were put in, most companies used 3, and we'll talk about what those 3 charts usually were. And then in the list of other measures, it was 3 to 7. Most companies went on the lower end of that range and did 4. Now, in terms of what was used for the TSR peer group, to summarize again, you could either choose between using your compensation peer group, a performance peer group, like, a performance group that you would use for a TSR plan, or an index. And the vast majority in that light green at 81% used a benchmark index. And so that was usually the same index that the company was using to compare their performance as is used in the performance graph in the 10K. So it's usually an industry specific index. And most companies went that route because if you look into the rules, if you use a compensation peer group, for example, to the extent that the peers change in each year, you've got to recalculate TSR for each of those years every time you do the disclosure. And as you think about it, most companies evaluate their compensation peer group on an annual basis, will make changes if companies, are acquired, merged, or for other reasons. So it makes sense to go with that established index because you don't have to deal with the complexity of that.
All right.
Yeah, so this next piece that we did was we're giving you some data on what the most common company selected measures were. We initially were looking at this among that larger sample that we mentioned, but the results were kind of all over the map. So what we did was we've narrowed in on the S&P 500 here just to show you for the largest kind of publicly traded companies what measures were used. And we organize this in the order that you usually see it on a balance sheet, starting with revenue, going to profit, cash flow, et cetera, just to organize it. And you'll see the rankings and prevalence here. And on the right hand side, we've shown where we saw that be the most or the top CSM in each of those industries. So not surprising, most companies, the most prevalent was earnings per share, followed by revenue or sales. Beyond that, as you see all the other rankings, it's mostly a profit-related measure, and then return-based measures were kind of at the bottom there. But what's interesting is there's some industries in which every single company was using the same measure. If you look at real estate, and this is really REITs, real estate investment trusts, all of them were using funds from operations per share. It just happens to be a measure that everyone in that industry uses. They all use it in their annual incentive plan. So of course they used it as their CSM.
Yeah.
So just interesting results. And I'll note, as we noted up front, most of this was measured on a non-GAAP basis where there were adjustments, and then they disclose what those adjustments were.
Yeah, but kind of getting back to kind of what it all means is you really need to look at your sector and look at what your benchmark index peers are doing, and then make a determination on what the right CSM is for your company.
Yeah. So that gives you some data on what we saw, and we just wanted to provide some insight as to looking at kind of best practices for this, and it's kind of hard to use the word best practices for PVP because one could argue that, it's just a compliance exercise. Let's just get it done. Let's just, do what we're supposed to do. But, companies want to know, really what are companies out there doing that you can view as a best practice. And to put it simply, what we've been telling clients is less is more. View this as a compliance exercise. Whereas I think, some other firms, maybe law firms, decided to err on the side of, putting more narrative in and really describing the relationship between pay for performance. But on that, what we saw is that a lot of companies just put the required information in the tables, added some additional charts to demonstrate the relationship between pay for performance, and left it at that and didn't say anything. And that's what we saw. As I mentioned, most companies did 3 to 4 graphics. The most common graphics that were used to display, pay versus performance were CAP versus 3 things: CAP versus your net income, CAP versus the company selected measure, and CAP versus your TSR and the peer TSR. So most companies very simply put those graphics in and didn't say anything else. On the other hand, there were some companies that didn't use the graphics and did, a page-long narrative describing the relationship between pay versus performance and what happened. I think we would argue, minimize the narrative on PVP alignment and really let the charts speak for themselves. Lastly, one other thing to think about in this is, I think a lot of companies preface their disclosure on this with a statement that the compensation committee does not use this to evaluate pay for performance. We do a number of other things. So I think what we might see next year is that the companies that are really ahead of the game on this will be thinking about really beefing up the section of their CD&A that describes how the compensation committee evaluates executive pay every year and what tools and methodologies they use with their external consultant to evaluate pay for performance. So we might see additional supplemental realized and realizable pay disclosures up front in the proxy statement, diving into more details on what the committee actually uses to evaluate pay for performance. On the other hand, I think committees are having their consultant compare their company to peers to get a sense of how their results compare to peers. And we'll get into that, but the results are kind of all over the board on that right now.
Okay, so what questions should folks be prepared to answer now that we've seen kind of the disclosures and seen what's happening in the market? Let's do another poll, Mike. Let's see. Mike, are you there? There you are. All right. All right. Did you receive, we're curious to hear from the group here. Did anyone hear any negative feedback on their disclosures? If you did a disclosure, did you get any feedback? Oh. From anyone, investors, media, employees? Yeah, if you haven't, if someone answers other, please put it in the chat so we can get a little bit more insight from that. Okay, one more second. Did anyone? Oh yeah. Oh, okay. Great. Okay, I'm gonna wrap this up. Here we go. Let's show the results. Okay. So everybody says none.
Yeah, I think that's what we expected. I think just like the CEO pay ratio rule, I think a lot of companies were initially concerned that they would get a lot of negative feedback. And I think the negative feedback on the CEO pay ratio was, some of it was in local media. And we expected we might see some local media reaction on some of this, but I think this has garnered even less attention than the CEO pay ratio partly because it's so complex and hard to understand. So it's interesting here. Some did get feedback from employees. So we'll talk about that. I think, a lot of employees look at the proxy statement every year and see what the executives are paid. And, when you see these large cap numbers, I think that raises a lot of concern from employees, for example.
Right.
So yeah, so what we prepared next is just a list of some of the common questions that you might receive, and just think about how to be prepared for some of this stuff. But as we saw, we didn't get much negative feedback. But this comes from a list that we actually, this is kind of a summary of a list of Q&As that we prepared for a client in preparing them for what they might expect. So first of all, just the first few questions are just anticipating that some people are going to be confused about this and asking, what is it about? So prepared just to have a description of what the rules are, and we provided that in here. People are going to ask about what is this rule about? What is compensation actually paid? What's this supplemental table with all these adjustments? What does that mean? So I think we've given you the answers to that. The next comes from just a kind of a left field question. Why did the CEO really receive $20 million last year? It's compensation actually paid. What's going on? And in this particular client that we prepared this for, the CEO did really have a high compensation actually paid number in 2021. And we really wanted to be prepared to describe why that is. And I think it's helpful to dive into the details of the calculation and look at what amount of that compensation actually paid is due to that unvested equity. You mentioned a big piece of this is the value of the unvested equity at fiscal year end. If you've got some really large cap numbers, be prepared to say, well, of that, 18 million of it hasn't even been earned by the executive because it's unvested. It's still subject to forfeiture if they leave. It's still subject to performance if you've got it in PSUs or stock options and so on. So the kind of questions 4 and 5 are the same. Just be prepared for the CEO and your other NEOs. If you've got some high cap numbers, be ready to explain them. Why are they're negative cap numbers? We mentioned that, if you have a negative cap number, investors or employees might ask about that. And, just be ready to describe that. That's due to the difference in stock price from years, 2021 through 2022, for example, and the fact that it's based on that equity valuation. Question 7, does the comp committee consider the results in making annual determinations of NEO comp? I think in the first year here, a lot of people flat out said that we don't consider this in evaluating pay versus performance. So I think for this type of question, just be prepared to list the things that you do with the committee to evaluate, executive pay and performance year over year. Yeah, and the last thing is how do the company's PVP results compare to peers? So I think work with your consultant or do some analysis, as Brooke is going to show you. We've got a tool available to you, but compare your results to peers and see what insights you can glean from that. So Brooke, I'll turn it over to you for this section.
Great, thank you, Adam. And yeah, this is a good segue into how do we use real examples here, and how do we kind of bring this home for folks that are on the call today. So we just took a stab at using the main data group platform. I'll show you how to get to it. Actually, the great news here is WorldatWork has a relationship with main data group, and we allow you to access not only our platform, but our BI dashboards, as well as build your own peer group for free as part of your WorldatWork subscription. I'll show you how to get in there, but I wanted to give you an example of what we did here. So we said, let's just say you're New York Stock Exchange chemical company called American Vanguard. We just picked this out of thin air. This is not scientific. We just said, let's look at a smaller company, like in terms of like under $1 billion in market cap, and then revenue under 500 million. So how would we, for example, go about this peer analysis, like Adam was discussing throughout here and just in the FAQ portion? Like, we're looking at our benchmark index and we have some questions about our performance against our peers. Where would I go to find that information, and kind of what tools are out there available to me? So good news, again, is if you go into your WorldatWork profile, all you've got to do is go to this resources tab here. You just have to log in, go to resources, and then there's a salary data center under the tools. So the main data group is here, and you just simply click to access that, and you're into the system. and you can build your own peer group. So for example, back to American Vanguard Corporation, which is a smaller mid-sized chemical company. Just to show you kind of how these charts work and kind of how this would work for you. If you were to go in here and look up your own company, you could create your own peer group. And you would then be able to see here, you could set your own company as a focal company. Here we've used, again, and the American Vanguard Corporation as the focal. And you can see here what the non-ranked financial measures are, as well as the non-financial measures are, as well as over here on the right table, you can see what your peer group SCT looks like and how you're comparing against it. This is an interesting example where they're a little bit lower than even the 10th percentile. So this is kind of what yours would look like. For example, you pick your focal and you'd be able to kind of report out some of these key charts if you're getting quick questions from shareholders or want to do some additional analysis, as Adam mentioned. And then there's another piece to this as well. You can do the scatter plot here on the lower right that also shows kind of how your performance is on your mapping against the cap for CEO against the SCT total for CEO. You can adjust these charts and they're interactive, so you can play around with them. This also talks about what the CSMs are. And so on the left here, we have what CSMs are, and the count per CSM per peer group. And then we also got the non-ranked metrics on the right. We've also got disclosure down here in terms of what the GAAP and non-GAAP CSMs are for your group. So these are the charts that you can create for yourself, again, using the WorldatWork platform and the main data group data center within that platform. So this was just an example of how you would do that and how easy it is to use. You just simply create your own peer group and go in here and start be able to create these reports. Any other further insights on this, Adam, that we want to share?
No, I just think this is a great resource that, gives you kind of all the data we just talked about, but, does it on a peer group. And I think, this is the type of stuff that committees are looking at. They're curious on how the results compare to peers.
Yeah. Great. I'll let you
So,
take it here.
yeah, so to that end, we wanted to show you something that we've done for a compensation committee that we're doing for, our compensation committees, just to make sense of their results relative to peers. So in this example, the client is in the green arrow on the right-hand side, and then the peers are in blue. And this shows on the horizontal axis that 3-year index TSR, and the vertical axis shows average compensation actually paid and average summary compensation table and average cap over that 3-year period. And in this example, the client happened to have the best 3-year index TSR, but their SCT, their summary compensation table data was kind of right at the median, but their cap, which is the arrow up there, was like third, or was like second among their peer group. So I mean, this just demonstrates that, when you're looking at the cap versus the peers, although their cap is kind of in the higher range, they had the highest performance. So it's just kind of a way of, starting to see your pay versus performance relationship. Also, you'll notice for the client, there's quite a big delta between the summary comp table dot and the cap arrow. And, that just goes to show you this company had the highest stock price performance relative to the peers. It's no wonder they had kind of a big delta between their cap. Yeah, so that's kind of the basics of what we're showing the clients. But beyond this, experts are looking at these results and trying to see what really major trends can we see from this data? How do we really evaluate this? And on the next slide, we're just kind of ending with some examples of, some leading edge analyses that are out there, what some of the experts are thinking about. So in that chart we showed you, there's, for the client, for peers, comparing your summary compensation table data to cap. What some people out there have been starting to think about and do is look at what is the total amount of your cap in excess of the SCT comp. So that's simply taking your cap number minus your SCT number and looking at the difference. And, people are making that interesting comparison because they want to think about, how do you really compare kind of the excess amount people received over their disclosed comp relative to performance. So people are going so far as to take this number and compare it to TSR relative to both the company TSR and peer group TSR. And lastly, one other way to think about this is like a sharing ratio. So, these are large numbers. We were talking about the $20 million CEO cap example, but I think it's helpful for shareholders to think about what was the value delivered to shareholders over that same time period. So we've seen some people take this cap in excess of SCT number and express it as a percentage of the change in market cap over that period. So if you look at the $20 million delivered to the CEO, if market cap increased by 4 billion over that period, is that an issue? And by doing these sharing ratios, you're able to kind of normalize the results based on performance and based on size.
Yeah.
So just some ways that kind of the experts out there are looking at this. We're seeing some interesting results in this, but it will remain to be seen how this evaluates or how this develops next year. I think as we mentioned, most companies have put their plans and processes in place, and hopefully these disclosures will be a lot more easy and straightforward to prepare next year.
Yeah. All right, now it's time for Q&A. So I'm going to start us off with a question we've gotten actually from a couple of clients, or just in our sphere of influence. And it gets back to those graphics versus the narrative. So for example, if you're a company and you're trying to decide, should I do the narrative? Should I invest a lot of time in doing a narrative and explaining the relationship, or should I invest my time in the graphics because it's a simpler solution? But what if my graphics don't show a great story or a great relationship? Kind of what are the trade-offs between narrative and graphics in the situation where it might be harder to write the narrative, but the flip side is my graphics don't look that great? So what do you advise clients in that situation where they're kind of caught between two not so great options on that?
Yeah, this is something that we encountered with a number of clients, and it's interesting that often we were working with law firms as well, where a client was working with a consultant to do the calculations and a external legal counsel to draft the disclosure. And oftentimes the legal counsel would recommend preparing a lengthy narrative describing the relationship. But we saw that kind of evolve as companies were putting this together, that most companies decided to move toward just the graphic disclosure route, even if the pay versus performance relationship was tenuous. And in thinking about this, what I've been advising clients is, if you have that issue, just do the minimum graphics, but think about somewhere else in the proxy statement. Again, getting back to that section on how the compensation committee evaluates, executive compensation and the tools and resources they look at. Beef up that section to describe what other things that you do to evaluate pay versus performance, and that might help your case.
Right, getting back to those best practices of less is more, kicking it into the CD&A, and just kind of viewing this overall as this first round as a compliance exercise, and then next year seeing kind of a little bit more deeply what people are doing and kind of what it all is kind of netting out with.
Yeah.
Any other questions? Do we have any other questions in the chat or from the audience? And any other things that you're seeing too, Adam, as part of this disclosure season or proxy season? I was wondering kind of how often are you seeing folks saying, hey, I'm going to do this myself, I'm going to DIY it, and then kind of wrestling with it and then figuring out, ooh, I do need some advisory. Kind of what types of tips would you give people if they're trying to kind of do it themselves and then they run into headwind? What do you?
Yeah, like for example, if you're an emerging growth company that didn't have to do it this year, but you're getting out of that status and you will need to do it next year, start early. Start very early on this to make sure that you've assembled all the data that you need. Because what we often found is that we'd go through a complex calculation and then we would get data from clients saying, well, actually, this executive was terminated, the award was forfeited. And if you don't have that additional information, it just requires a lot of, going around in circles.
Yeah.
So yeah, just make sure you've got the complete level data that you need. I think a lot of the time is spent up front just putting the data requirements together and making sure that from the various platforms where you've got equity information, where you've got bonus payout history, that you've got that all in one spot.
Right, because you're going to ultimately do it multiple times if you don't have the right data set to start with, right?
Yeah. Yeah.
Okay. All right. I think, Mike, we're complete here with the audience. If there's any further questions, please don't hesitate to reach out to us. I think we've got some contact information here. Hold on, let me see if I've got that handy. Here's our contact information. And please, take a look for the slide deck in your inbox.
Perfect. I would like to thank you, Brooke and Adam, for sharing your knowledge and time with us. And I'd like to thank everyone for joining us today. This webinar will be available for playback for up to 90 days. Simply log into world.work.org to access your profile, but please allow 24 hours for that playback to appear. And a reminder that we are going to email a short survey at the end. Highly appreciate your feedback. I'm going to stop the recording now to share the HRCI and SHRM credits slides. So thank you all for attending. Until next time, have a wonderful day.
Thank you.
Thank you.
Bye, everybody.